All right. Welcome to Financial Independence Retire Early, South Africa. My name is Berg. I'd appreciate a like and a subscribe if you haven't already. The legit go a long way, so please hit those icons, buttons. You know, on this 11th episode, I'll be doing another. You heard me right? Another definitions, context, jargons episode. I truly believe these are important. I'm going to reiterate, especially as a English is not my first language, so I know how important understanding is in proper business functioning. The better you understand these terms, the better you can be communicated with, and the better quality decisions you can make. You know what I'm saying? Um, Information and knowledge are power, right? So I just believe that we need to improve our understanding of these words so that we can improve our business processes and our functioning. You know what I'm saying? So the first word for today is return on investment. I know you've heard it before, but return on investment is just the performance measure of profitability of an investment. Basically, it's a percentage that is tied to the amount investment, and it's a percentage of profit, right? So that's RI. The next word is IRR, right? IRR is internal rate of return. Internal rate of return is an annual growth rate an investment is expected to generate, where the net present value is zero, and it is used to estimate profitability or rate of annual return, right? It's an annualized rate of return, but it's a projected return because they say that IRR is an annual growth rate an investment is expected to generate. I was reading a document a few days ago by this other company, and they had an IRR, net IRR there on it. I'm like, oh shit, that's such a great return you guys made, only to realize it's actually a projected return, which to me just emphasized how important understanding is, in order to make the right decisions. So IRR is an annualized growth rate that investment is expected to generate. The next word is EBITDA, EBITDA. EBITDA, EBITDA. EBITDA is your earnings before interest, depreciation, tax, and amortization. Amortization, I think, is just like cost recovery, um, or payments made, something like that. So, your earnings before interest, depreciation, tax, and amortization. So, obviously, this is like when you read that, the value will always be larger because it is the company earnings before subtractions by interest, tax, depreciation, and amortization. So EBITDA is just your earnings, which is usually a larger number, or your net earnings before interest, depreciation, tax, and amortization. The next word we have, or phrase, is fiscal policy. I know fiscus is a purse, right? But fiscal policy is the use of government's collected revenue, right? Typically to stabilize countries' economies by manipulating the levels and allocations of taxes, right? So fiscal policy relates to the collected revenue that a government makes or has, and how they use it to stabilize their country's economy, right? Which works closely and hand in hand with what is called a monetary policy. But a monetary policy is more so a macroeconomic policy laid down by a central bank. In some countries, they work closely together, but they separate, right? Central banks and government. But in some countries, they're the same thing. But basically, the difference between monetary and fiscal policy is that fiscal policy is dependent on collected revenue and is used by government to stabilize the economy, while monetary policy is usually the demand and supply control of money by a central bank, and is used as a macroeconomic policy. To they use interest, they use money supply, demand, the side of the economy, basically to control inflation, growth, and other things, right? So monetary policy is a macroeconomic policy laid down by a central bank in how they arrange monetary supply and interest in order to control the demand supply of the economy, and used by in close relation with government to contain things like inflation, growth, etc. The next one is deficit. Deficit, right? In finance, a deficit occurs when expenses exceed revenue, right? Or imports exceed export, right? Your liabilities exceed your assets. You know what I'm saying? You're spending overseas your income, right? Then you have a deficit, right? So a deficit in finance, a deficit basically occurs when your expenses exceed your revenue. In a country, mostly when your um, imports exceed your exports, or when your liabilities are bigger than your assets, or largely when your spending, is just bigger than your income, then you have a deficit. The next one is commodities. Yeah, commodities, we heard this one before, also is like basic goods that are used in commerce, and interchangeable with other goods also. These could be natural resources, like oil, grain, beef, gold, and they are largely consumable inputs, like they inputs are used in like consumer products or just for like large scale human consumption, right? So commodities are just basic goods rather in commerce, um, which are interchangeable with other goods, and are largely consumable products, right? Like oil, grain, beef, gold, and so forth. Yeah, gold is a natural product, right? It's a natural resource. You know what I'm saying? I know, like, is gold natural? Yes. So, anyway, global supply chain, right? Also, we hear this phrase a lot of times, and we expect it to understand what it means, right? But a global supply chain is a network that can span along multiple continents or countries for the purpose of sourcing and supplying goods and services. Basically, the flow of information, processes, and resources across the globe in order to create the product or services that you're producing and selling, right? So your global supply chain is basically where you source information, processes, goods, parts, anything that basically your entire network that can span along multiple continents and countries, basically for the purpose of serving and supplying goods and services, so it can relate to information, processes, resources, and so forth. And your value chain, right? Your value chain are the set of activities and processes that an organization carries in order out to create their products and services, right? So these are logistics and operations. So your value chain is basically the processes and activities that happen by an organization or a company in order to ultimately produce their products and services. In some instances, the phrase value chain is used as it relates to the inputs of your products and services, like as you go up the value chain of your company, understanding the inputs that creates your product and services, right? So you might not necessarily be in control of the input. You might just be selling the final aspect of the product or the service, but you're not necessarily in control of all of the inputs, beginning with the natural resources, right? So basically, a value chain can also relate to understanding up the layers of production and manufacturing, all of the inputs and all of the levels of inputs that are necessary for the creation of your product and service. That's another definition of value chain. That's similar but different to this one that I just gave you now, which is a set of activities that an organization carries out in order to create their products and services. Then the next one we have here is scaling. As an entrepreneur, you hear this phrase a lot, scaling. Scaling just means growing your business, right? For example, I'm going to begin with economies of scale, right? Economies of scale are cost advantages which are reaped by companies when their production becomes efficient, right? So your increased production can lower your costs, right? As the costs are spread around the multiple or increased number of products that you create, right? So basically, your efficiency increases, the number of products that you create increases, and then you take advantage of the cost deductions that occur because of increased efficiency and also economies of scale, which means, right, because you produce larger amounts, you need large amounts of inputs, which can be cheaper, and all of that feeds into your economies of scale because these are cost advantages which are reaped by companies when production becomes efficient. Increased production can lower the costs of production because the costs are spread around the large number of goods that are produced, right? And then scaling again also refers to how can you grow your company, right? How can you support growth of your company without hampering the effectiveness of its production? So that's how scaling and economies of scale are related. Economies of scale are just the cost benefits that comes with increasing your production, right? But scaling in your company is how effectively can you grow your company without hampering cash flow, um, you know, and growth and all the things that are important to the company, right? The next word or phrase we have here is cost of capital. Cost of capital. Now, the cost of capital is the cost of a company's funding, right? Whether it's debt or equity, right? So it is the required rate of return or the minimum rate of return that investors expect in order to provide capital to the company. Thus, it sets a benchmark for the performance of the company, right? So your cost of capital is how much you need to return just for your investors to invest in you, or just so you can pay off your investors and remain afloat. That is your cost of capital. It is the cost of a company's funds, whether in debt or equity, right? Which then provides the required rate of return, the minimum rate that investors expect to provide you with capital to your company. They thus set a benchmark of performance. That is your cost of capital. We have something also called sunk costs, right? Sunk costs are costs that have already been incurred and cannot be recovered by the company. So sunk costs or sunken costs are costs that already been incurred by the company and cannot be recovered, right? These can also be called retrospective costs, right? Which are sunk costs, which some people say have no relevance to the future decision making of the company. That's another way they try to show what are sunk costs. These are costs that a company has already incurred, but in reality they have no real bearing to the decision making of the company in the future, right? These are sunk costs. We have something called a sunk cost fallacy. I've heard about it in gambling, right? Where a sunk cost fallacy is where somebody does not want to leave the table that they're playing or gambling at because they feel like, oh, I've already invested so much, I should probably win by now. You know, you know what I'm saying? Like, you know, you work so hard in your company, or you invest so much in your company, or like I said, in gambling, you know, you've played so many games, you've played like 20 games, and you've lost like 20,000 rands, and you're like, I know this 21st one, I'm probably gonna win. You know, I can't keep on losing and losing. So it's a fallacy that there will be a return just because you invested so much. You know, it's a fallacy that you'll win just because you're working so hard. Right. It's difficult, but it's, you know, it occurs in business a lot where you need to, you know, as they say, cut your losses. You know what I'm saying? So a sunk cost is a cost that the company has already incurred and cannot be recovered, and usually has no bearing to the future decision making of the company, which relates to the sunk cost fallacy, right? Where because you already invested in so much in a company, you've already spent so much time or money in a company, you feel like you should win anytime, but in reality, it's a sunk cost. Like, it cannot be recovered. It's gone. And then therefore our next phrase is now runway. Runway. Runway is the amount of time that a company has before it runs out of money. Simple as that. What is your runway? Your runway is the amount of time that your company has before it runs out of money. But runway is determined by burn rate, right? Burn rate is the amount of money spent every month, right? And then it's used to calculate how much money you have left until the company runs out of business. So your burn rate is effectively how much money you spend every month, and it determines your runway, because your runway is how much time you have before the company runs out of money. So if your burn rate is 10,000 rands a month and you have 100,000 rands, then your runway is 10 months. Because if you do not make any income in the next 10 months, or if you do not get any further investment in the next 10 months, then you reach the end of your runway, and like Wile E. Coyote, you fall off, and the company done, the company dead. So that's the how runway and burn rate work hand in hand. Burn rate are your costs per month, and your runway is how much time you have before the company runs out of money. The last phrase we have today is cash on hand. Cash on hand is basically the total amount of any accessible cash that a company has, right? Your cash on hand is the total amount of all of the literal cash that a company has, but also cash equivalents. So you will hear the phrase cash on hand or cash to cash equivalents, cash or cash equivalents. Now, cash equivalents are treasury bills, government bonds, stocks held in the public market, but basically any investment that can be turned to cash within 90 days. You know what I'm saying? So your cash on hand or your cash equivalent is all of your liquid assets. Basically, the cash that you have, your treasury bills, your government bonds, you know, your stocks holdings, but basically any investment that can be turned to cash within 90 days. That's your cash on hand. So you see how your cash on hand, your burn rate, and your runway work hand in hand, right? Especially as a startup. These are phrases and questions that you hear a lot as a startup. But anyway, to go through today's words again, we have return on investment, right? Percentage that shows the profitability or the profit of an investment. You have your IRR, your internal rate of return. It's your projected return rate or your projected profit. You have EBITDA, your earnings before interest, depreciation, tax and amortization. So that is your net earn, or your larger earnings before deductions, and your deductions will be made by interest, depreciation, tax, and amortization. Then you have fiscal policy, which is usually government's collected revenue policy and their planned spending. And then you have monetary policy, which is macroeconomic policy, which is usually laid down by a central bank, and then how they also hand in hand work with government to control money supply, interest rates, inflation, growth, and so forth. Then you have deficit. Obviously, a deficit is when you spend more than you earn, whether you're a company, a country, or an individual, right? When your liabilities are bigger than your assets, when your income is larger, when your spending is larger than your income, and when your net exports are smaller than your net imports, right? And then you have commodities, which are just natural assets or basic goods that are used in commerce and can be interchanged. Global supply chain, the network that you use to create your products and services. Your value chain, the specific steps in value add from the natural resource into your finished product that a product takes or a company takes in order, again, to go from natural resource to final product. You have scaling, which is, can you grow your company in a sustainable way, right? Economies of scale, or economics of scale, is basically cost advantages that come with increased production efficiency, and also increased unit production, right? So the more units you produce, the less the cost of production per unit. You have your cost of capital, which is the cost of debt and equity, which is basically your minimum rate of return that you need to create in order to receive capital, right, or investment. Then you have your sunk costs. These are costs that cannot be recovered, right? And it relates to your sunk cost fallacy, right, which is feeling like you should make a return just because you spend so much time and money, but in reality you might not. Then we have runway, which is just how much time you have left until your company goes bust or until you run out of money. We have burn rate, which is the rate or how much money you burn per month. And then last but not least, we have cash on hand, or cash to cash equivalents, which is basically any cash or cash equivalent, which is an investment which you can turn to cash within 90 days, like stocks, bonds, treasury bills, and so forth. Thank you very much. I'm going to read the words one last time. Cash on hand, burn rate, runway, sunk cost, cost of capital, scaling, economies of scale, value chain, global supply chain, commodities, deficit, monetary policy, fiscal policy, EBITDA, IRR, and ROI. So nobody should ever tell you that you don't understand what you're talking about, or you should never feel like you don't understand what you're reading, because Bird is helping you understand all of these words, definitions, and contexts and jargons for finance and investing, right? Hit the like and subscribe button. Thank you very much for watching. Also, my WhatsApp number is down there, my Facebook, my Twitter, my Instagram, all of that, TikTok. Join the community. Let's try and, get this financial independence so that we can retire early. I love y'all.